And now it gives me great pleasure to welcome Ben Crawford and Michael Riedel.
Hey, thank you, Mark. It's great to be here. I'm Ben Crawford, the CEO of CentralNic. I've been CEO for 12 years now, and it gets better all the time.
Thank you. My name is Michael Riedel. I'm the Group CFO of CentralNic since 3 years, but with member companies of the group since more than a decade, which is literally most of the time this industry existed.
Great. So thank you all for joining, and let's get started. We can keep going, please. That's it. Great. So, what are the main points about CentralNic? Well, we're a fast-growing company. Our organic growth for Q1 this year compared to Q1 last year was 16%. So we're growing fast, and we're growing faster than we ever have before. We're a business completely focused on recurring revenues, so a low-risk business, and certainly compared to normal ways of valuing companies like ours, we're undervalued. Now, let's get on to the revenues. So essentially, from a revenue perspective, we're a business of two halves. One half is we sell domain names, and we'll go into some detail on that. And the other half, we provide online marketing services. We actually used to call this business activity monetization, but it's grown and evolved quite a lot, even in the past 12 months. And we think online marketing services is a clearer way to explain what we do. Now, 99% of our revenues comes from selling recurring products. And of our EBITDA, it's the same thing. Only 4 years ago in 2017, almost half our revenues came from non-recurring business activities, so where we did one-off sales of items. And we realized that to align ourselves with what investors want, to make ourselves much more investable, we needed to change that. So we actually ceased a bunch of the activities which we were doing previously and just built out the recurring revenue part of the business. As well as recurring revenue, we have over 100% cash conversion. And that's for a pretty simple reason. We don't give most of our customers credit, so they have to pay us in advance, whereas our suppliers do give us credit, so we pay them in arrears. And so it's just the period of time in which we hold cash really builds up our cash conversion. Now, compared to our peers that sell domain names, companies you may know of like GoDaddy and 1&1 and 123reg, we are still very light on what we call the value-added services. So that's selling things like hosting, website building, email, brand protection, online marketing, and so on. So now, on online marketing, is the first one of those kind of non-domain services that we've got into, and that's already growing at 19%. So clearly, we feel like as we introduce additional products and services, we will be able to increase our revenues and our margins from existing customers. Now, the main way that we're growing at the moment, we have, as I mentioned, 16% organic growth, but if you look at our year-on-year growth, it's over 100%. And the reason for that is it's a highly fragmented market, which we are making acquisitions in. What happened was our industry started about 20 years ago, and around the world, small companies set up to start helping their local businesses get online, get their own websites, sell things online, get corporate email addresses, and so on. All of these companies, these service providers do the same thing, but they're focused on different national markets. And what's happening over recent years is we and other companies like us started acquiring those businesses, changing this industry from being a local industry to being a global industry. For us, how have we achieved this record organic growth over the last year? Firstly, we've centralized the back office activities. So basically, the people that are running our different business units no longer have to worry much about finance, accounting, HR, even project management, documentation, and so on. We've really centralized the core there. And we've also invested on putting new people into leadership positions to drive our revenues. We've also consolidated many of the companies we bought into distinct divisions, and so each of those divisions is focused on great product, great service, and expert support, and we've seen great results from that. Summary of like what our business looks like. We're a global business. We have hundreds of thousands of customers. We have customers in nearly every country in the world. On the domain name side of the business, there's around 370 million domain names in existence, and 45 million of them use at least one of our platforms. So that's 12% of all domain names. Next page, please. So what is our market like, and why is it growing? So first of all, the internet itself, the growth of the internet drives the growth of our business. So at the moment, about 4.66 billion people use the internet. It's about 60% of the global population, which is about 7.7 billion. And that is growing at about 7% per year. Now, all of those people who use the internet, it means that suddenly, if you didn't use the internet before and you start using it, it means that the services that you use have to start using the internet as well, the businesses that are supplying you. And that drives the increase in the sale of domain names, which are used for websites and for corporate emails. So domain names and web services is roughly a $30 billion business, and its growth is at about 3% per year. So that's all about the infrastructure that we provide and the tools that we're providing to help businesses get online to serve these new customers who are just getting online. Now, what's growing much faster than that is the actual size of the business that's happening online. So in other words, how much money people are spending online, how much money they're making online. So e-commerce is a $4.3 trillion market in the year 2020. So 18% of the global retail economy is online, was online last year, and it's growing at a rate of 27%. So in other words, the business activity on the internet is expanding way, way faster than just the number of, say, websites and domain names. And when you think about it, so there's online retailers are making over $4 trillion, and they and others are spending about 10% of that, about 400 billion on online marketing. So what does online marketing do? Basically, it's spending your marketing dollars over the internet to acquire new customers. And obviously, why are you acquiring new customers? Because you want to get a return on that investment. So if you spend $10 to acquire a customer, you want to make sure that the margin you make from what you sell them is more than the $10 that you've spent to acquire them. And that's a very important dynamic, because obviously, if you're supplying online marketing tools to people to acquire new customers, and they can continuously and predictably get a good return on investment, that means you've got recurring revenue. You've got someone that will spend and spend and spend and spend day in, day out, so long as they're getting a good return on investment. Next page, thank you. Now, back to the domain name and web services. Let's go back to basics. what do people do with domain names and why do they need them? So firstly, domain names are used for corporate email. If you want a common email address for everyone in your company, you need to buy a domain name matching your company name in order to do that. Secondly, if you want a website for your company, again, you need a domain name for that. So those are the kind of basic uses of domain names, but they're not the only uses. Brands, large companies also view domain names as the equivalent of online trademarks. So just as they would go to their trademark lawyers and say, could you please register trademarks matching my brand names in every country in the world to protect my brand in all those countries, they will equally come to us and ask us to register the domain names matching those brand names in every country in the world to protect their brands online. And so a large company may, and say our largest clients in this area will register up to 50,000 domain names and renew them every single year because they view this as a way of protecting their brands and indeed a component of their brands. Lastly, domain names have one other use, and that is they're used as inventory for domain investors. So out of the 370 million domain names in existence, around 100 million are in the hands of domain name investors. And those investors have two business models. One is they buy domain names, and typically the way they get their domain names is that if I had a business, I had a business activity, maybe I have a whole lot of shops and I decide to close one of those shops, I let the domain name for that shop lapse. I don't need it anymore. I don't have that shop. A domain name investor will buy that domain name. And the reason is, firstly, it's already been proven in the market. Somebody wants it. Somebody built a business around it. And so when it becomes available, it's likely that another entrepreneur will like the same name and want to re-register it. And will be willing to pay money for it. Because if you're launching a new business, you don't care that much whether if to get the perfect domain name, perfect web address for your business, you might be happy to spend hundreds or indeed thousands of dollars for that because it's an important piece of your marketing and your branding. But the second model that domain name investors use to earn a continuous recurring revenue is what's called domain name monetization. And the way this works is that the customers that used to go to that online shop that I had or the website of the shop that I had, they clicked on links. They probably have sitting in their email old newsletters that I'd sent them. There are links in there. They might have it bookmarked, that web address, and indeed they might just remember the website that they used to go to. And so in other words, those customers keep coming back to the domain name. So the domain name itself continues to attract traffic after the website that was on that domain name is gone. That traffic is very valuable. As we've heard, $400 billion a year is spent buying traffic, getting traffic from other websites to come to your website so that you can acquire that customer and sell them something. And so to have that kind of super targeted traffic that used to go to a particular shop, obviously those people want to buy a certain thing, they're in a certain area. And so advertisers who are also in that area selling similar things are going to love that traffic and pay handsomely for it, so long as they can get a good return on investment. And so that provides recurring revenue to the domain investors and, of course, equally recurring revenue to us because we're providing all that technical solution that allows them to monetize their domain names. And I'll come back to that. Now, what are the key characteristics of the domain name market? Domain names themselves is about a $5 billion a year market, but nobody really just wants to buy one domain name. Why would they? If you're a small business, you want to get a domain name, you want to get a website, you want to get a corporate email address, for instance, you want to buy e-commerce software, you need security certificates. you need payments and so on. So there's a bundle of other products and services that you want together with domain names. Similarly, if you're a large company, you don't want to get one domain name. You want to get a whole raft of domain names from all over the world that all relate to your brand. But similarly, but also you want to get online brand protection services. So these are services, for instance, where people monitor the internet to see if somebody else is trying to register a domain name that includes your brand in it. That's something that you would want to stop, if that's, especially if that's the first step towards people actually selling counterfeit goods using your brand. And so that's an example of an additional service that a large company would want. Similarly, domain investors need monetization services. And so, in other words, around this $5 billion market for domains, there's a $25 billion market for domain-related internet services that are typically bundled with domain names. Now, another super important thing about our market is that we're immune to economic downturns. So I mentioned to you that I've been with CentralNic for 12 years. I was running a business in New York 12 years ago during the subprime crisis. We actually shut down, and but CentralNic was hiring, and it was growing during the 2009 subprime crisis. And similarly, last year, the year of COVID, was our best year in an entire history of the company, not only in terms of revenues and profits, but in terms of growth. So, and why is that? Well, because obviously in times of economic crisis, particularly last year, more and more people took to the internet to try and make money, setting up more websites, more online businesses, and so on. But also for those that, even if their businesses were struggling, to stop paying for your domain name means, one, it's only a small saving. Domain name costs about, between say £2 and maybe 30. So it's a small saving, but if you don't pay for your domain name, your email stops working, your website goes down. So you might as well pack up and go home at that point. So naturally, it is very robust and very resilient against economic downturns. Next important point is that renewal rates of domain names are very predictable. And what that means is the forecasts are super predictable and can be checked with industry statistics. So as an example of that, 79% of .com domain names renew every year. So what that means is, out of every 100 domain names, 79 are renewed by the people that currently are using them, and 21 are not. So out of those 21, they're dropped. But as we've heard, for many of those, domain investors will buy them. So the domain names won't disappear, they'll just change hands, essentially moving to the secondary market. And that makes the business incredibly predictable. And so it's not only recurring revenue, but it's predictable recurring revenue. Secondly, the growth of the industry has continued, and I remember when I started this job 12 years ago, people said, well, don't you think that domain names are kind of coming to the end of their life because every company is going to be using apps now? It was 12 years ago. Every single year since then, domain numbers have grown. .com and the other domains, including .co.uk, have put their prices up over that period. And of course, Amazon's out there telling small businesses, hey, you don't need your own website, just put a store on Amazon. Facebook's doing the same. You don't need your own website, just use a Facebook profile for your business. And app developers are saying the same thing. Hey, just get people to load an app on their phone, then they won't have to find you on the internet anymore. And all of those businesses are totally legitimate and good services, and they're growing too. But so too is what we call the open internet, where each company owns its own web address, its own website, has its own corporate email, and so on. And so there is no new threat to this market. All the threats, all the competition, the substitutes have been there for between 10 and 20 years, and we all grow side by side. Now, this next point is really super important, and that is, this is the highest stickiness business I've ever been involved with in my life. So roughly 2% of customers change suppliers each year, only 2%. What that means is it's a tough business to compete in, because it's very, very difficult to get your competitors' customers to leave them and come to you. We do it. We do it every week, but it can take months or even years to persuade them to come across. And then there's costs involved, there's complexity. Everyone's worried about risk, risk of losing domain names and so on. And so it makes it so what that means is that essentially everybody keeps their customers, and that makes it a fabulous industry to do acquisitions in. Where I used to work in the sports industry and the publishing industry, like media industry, and those are tough industries to do acquisitions in, because you're always worried, hey, if I lose key staff members, could I lose customers and so on. In our industry, it's never a problem. That people, 98% of customers every single year will stick with you come hell or high water, and that means you can buy a company with absolute confidence that that company's customers will stick with you after you bought them. And then lastly, as I mentioned, it's a highly fragmented industry, and I've talked about how when we started, there were companies in every country in the world almost giving these services to local businesses. Now, there have been companies doing roll-up strategies around the world for a few years now, but 50% of domain name vendors globally are still independent and still acquirable. And that means that that we still have lots and lots of runway ahead of us to continue growing inorganically as well as organically. Next page, please. So that was about our domain name business. Now let's move to our online marketing business. I'd say, so whilst both the businesses are recurring revenue, high cash conversion businesses, the difference is that the domain name business with its subscription base is a lower growth rate business, whereas the online marketing is more of a utility model. So instead of a subscription model where you have to pay once a year or you lose something, this is where you basically are paying for usage every day as you use something. And obviously, so long as that service is continuing to give you value, you will stay on and continue to use it. So how does online marketing work? Basically, anyone who's serious about the internet, doing business on the internet, falls into one of two camps, and sometimes both. So the first camp is you're selling something over the internet. You need to spend marketing dollars to win new customers to buy whatever that is you're selling over the internet. So that's what we call the demand side. And because what you're demanding is customers, is traffic, we call it. And so essentially people click around from website to website on the internet, and what you're doing is paying to get that person to leave whatever website they're on, dailymail.co.uk, you stick an ad on there, you're trying to get them to come to your website, but you're trying to obviously make sure that the ad just brings the right people, the people that will actually buy from you. And so it's a $400 billion was spent last year by people trying to buy traffic and acquire customers like that on the internet. And half of that, all of that money, roughly half of them, was 189 billion, was spent with Google. And so Google has this massive machine called Google AdSense, which allows businesses to go on there and buy ads. And they can buy ads on Google Search, they can buy ads on YouTube, but they can also buy ads outside of the Google universe through people who have cut deals with Google to sell their traffic to Google's customers. And then Google has a great service where they will allow the customers to acquire that traffic from third parties, and the customers pay Google, and Google aggregates all the payments. It's like a payment gateway and pays the partners like us. So Google has 50% of that. And then the other 50% is made up of many, many, many demand side platforms. Obviously, the second biggest one being Facebook, but then there's companies like Yahoo, and there's Bing, and then there's many, many others, which are basically online services where people will go to acquire traffic and spend their marketing dollars. So they'll put in keywords, say, look, I own a wine shop in Southwest London. I want to attract traffic here. So I want people who are searching for or going to websites related to the following topics. And it might be wine, red wine, white wine. It might be varieties of wine and so on, and people in particular geographic areas. And so if you can match up with traffic that has those characteristics, which means people surfing the internet that are interested in those topics, looking at websites related to them, clicking on ads related to them, then they will be good customers for you. So that's the demand side. Now on the supply side, you have the opposite thing. So these are people, these are businesses, online businesses that have traffic and would like money. And so the idea is they're selling their traffic to the first group of people, the demand side, and getting revenues on that basis. So obvious examples of this are sites like YouTube, Google search, but similarly dailymail.co.uk, social media sites, or social media applications, even TikTok, Instagram, etc. Anybody that's got lots of people using it, lots of traffic, is then trying to make money by selling that traffic, by getting people to leave their website and go over to the website of the advertisers. And so that's what we call supply side. And so domain name monetization, as I mentioned, is an example of supply side, in that domain names get traffic. And so therefore domain name owners, just like media owners or social media company owners and so on, are able, bloggers are another good example, that have a group of people coming to their website, are then able to sell that traffic, and that's their business model. Very good. And then it's probably worth mentioning there are people that do both. And so great examples of those would be things like, exactly, say Daily Mail website, where they might advertise in order to attract people to come there. And then they also sell that traffic. So they put advertisements on, and then the people kind of click on those advertisements and leave the site again. So they're paying, they're charging people to come to the website, and then they're getting paid for the people to leave from that website and go to an online store. And that's what we call traffic arbitrage. So that's people that are both on the demand side and the supply side. Anyway, what are the key market characteristics? I know I've repeated this a lot, but it's a great number. $400 billion in 2020, growing at 21%. As more and more commerce comes online. For us, how much money are we making in this part of our business? $150 million. Minute market share, amazing growth potential for us. Again, these are recurring revenue businesses. Everybody wants recurring revenue here. Nobody is just interested in one-offs. So what that means is, our businesses are largely about what we call performance advertising. And that means that people will test out, like an advertiser will test out the traffic. So, all right, let me buy a little bit of that traffic, get a few customers to come to my site from that source, clicking on that ad, and let's see how much they spend. And if you get a decent return on investment, it's like, great, okay, well, I'll spend more. And if it's a predictable return on investment, they're like, great, I will spend that every day. I will program a computer to say, so long as I continue to get that kind of return on investment, I just want to keep buying that traffic. And so this is again, not only is it a recurring revenue, but it's everybody has the same interest in building something that's recurring and growing, and we're one part of that. Again, largely immune to economic downturns. So Google, the largest player in the world in this, had one down quarter in the year 2020, their first down quarter in the history of them reporting their revenues. And then they more than recovered in every quarter since then. And so despite COVID, that's a company that is earning over $180 billion a year. And I would say our experience was actually not as bad as theirs. We didn't have a down quarter. So I wouldn't say COVID hasn't affected us at all, but we've proven to be hugely resilient, and so is the industry as a whole. Now, particularly this area of domain monetization, and I'd say all of our businesses actually are massively resilient to the other kind of things that have been recently reported as threats to the online marketing industry. So firstly, monetized domain names do not appear in search results. So whilst other companies may be reliant on saying, hey, I come up high in the search results, so I get a lot of traffic, I get a lot of customers, we don't depend on that at all. We never have. Our products don't appear in search results. And so what that means is, while other companies, Google changes the search algorithm, suddenly instead of being number one, they're on page 5 and all the customers stop coming. That can't happen to us because we were never ranked in Google search results in the first place. We have zero reliance on that. So Google can just change its algorithms every day. It disadvantages our competitors, doesn't impact on us at all. Similarly, we never have, we don't today, and we never will be about collecting private data of end users. That's a technology we've never touched. It's something we've never had any interest in, and we've never needed. So all of our online marketing business models are just about keywords. So it's not about collecting real personal data about anyone. It's just saying, using artificial intelligence often to analyze, what is this website about? What is this domain name about? Let's pick out some keywords, and if they match with the keywords chosen by advertisers, they get together, and then our computers optimize. So they change the keywords slightly. They say, oh, there's lots of buyers around that keyword. So if there's lots around wine, then they'll start saying, well, how about red wine, white wine, champagne, rosé, Chardonnay, and so on, and see what keywords they can use in order to get more and more high quality advertisers to come to them. None of that involves collecting end user data. And so we believe that the new privacy changes being introduced by Google, by the European Parliament, and essentially globally by Apple will benefit us, because while some of our competitors, their business models will suffer because they're no longer allowed to collect the data they use to make their business work, for us, it's an irrelevancy. And so they may lose some customers and they may come over to us. Customer stickiness, again, fantastic in our business. One of our companies, Team Internet, we analyzed it, and 90% of their customers they had 3 years ago and they still have today. So again, these aren't businesses where people drop in occasionally and buy something on a one-off basis. These are businesses where people actually use computers to continuously do the same commercial activity again and again and again in order to achieve a predictable return on investment for their business. And and we've talked about, and so we're very much about innovations. because I guess where we are is when you're in an industry that's kind of highly dominated by Google, Google have a kind of one size fits all type of solution, but the internet moves very quickly. There's new sources of traffic. Advertisers want new different types of approaches. And so to be kind of nimble and work with niches rather than try and compete, we don't go into the world of competing with Google or with Facebook. We work in kind of smaller niches. But the thing is, a small niche for Google, like Google won't go into any niche where they can't make at least $1 billion. And so that leaves a plethora of fantastic opportunities for us to build new solutions in order to mine these niches as they develop. And so and particularly with our excellence in performance solutions, meaning measurable solutions that deliver predictable ROI, AI-based optimization, which is what we're all about, and new innovations, we're absolutely confident in being able to continue with the growth that we've achieved in Q1. Next page, thanks, Amanda. So to summarize our strategy, you would have thought, I mean, we IPO'd in 2013, and I joined the company a couple of years before that. We're doing about $3 million in revenue. The analysts are expecting us to do about $340 million in revenue this year. So clearly, we've proven that we can build scale through acquisitions and organic growth, and again, year in, year out. And our plan is just to continue doing that. There's a lot of potential lying ahead of us. We'll be acquiring new businesses, but those businesses will be recurring revenue businesses, just like all the others we've bought. We wouldn't have gone to so much trouble to move out of the one-off revenue business into a pure play recurring business and then prejudice that. We're all about buying more recurring revenue businesses similar to what we do now, maybe, with new customers, new talented staff, maybe some new piece of technology, getting into new geographies at scale. But we're in this recurring revenue online services business. We'll be expanding our portfolio of internet services for the reason I said. We have customers every day buying domains from us and then going elsewhere to buy the other services they want to combine with the domain names. We want to offer them a better service, which is you can get all of that from us. And so we're gradually introducing additional services like Microsoft Office 365, so they can get their email and business software from us rather than having to jump off and go somewhere else. Because the key thing is this: we have the customers at the time they're setting up their business because they're getting their domain name. That's can be the first thing they do. It's not unusual for companies to do that before they've even registered their company name. And so while we've got them, we should be able to sell them, or we definitely can sell them, this range of other services. We just have to start offering them and doing the technical work to enable us to do that. And then lastly, I'd say, why did we grow at 16% over the last year? Whereas if you look in earlier years, it was more like 6%. And that is because we did restructure, we invested in new people, we've consolidated and integrated the back office functions, and all the new people we hired, they were hired for a reason, a clear reason. They were told, you got to drive organic growth. That's why you're here. And it's proven to be very successful. So, and I guess I'm making that point to make it clear, this isn't like an unexpected blip in our trading history. This was expected, this is planned, and now it's being delivered. So thank you very much. I'll now pass over to Michael to continue the story.
Thank you, Ben. All this is super exciting. The question that I want to explore with you today is, how does all what Ben just said translate into financial success? On page 8, which is currently on the screen, you see our growth since the IPO in 2013. Since that IPO, CentralNic has doubled its revenue, not in 1 or in 2 financial years, but in 6 out of 7 financial years. CentralNic's secret sauce here is that we can turbocharge our organic growth with a virtually incessant flow of acquisition opportunities. However, only very few companies in our industry actually manage to deliver and close these deals. As you can see on the bottom of the slide, since Ben and I teamed up, we've on average delivered 1 deal per quarter, and we're not concerned about being able to maintain that pace. This, together with our recurring revenue, makes us very comfortable to meet the expectations in the market, which currently stand at $312 million of revenue for 2021. When we move on to page 9, where we turn our attention to the latest results, we can without hesitation say that the first quarter of 2021 was the best quarter in the company history yet. Revenue increased by 48% from $57 million in the first quarter 2020 to $84 million of revenue in the first quarter 2021. And as Ben had alluded to before, the organic component of that is 16%. Last but not least, due to a very strong cash conversion and also a bit of tailwind from the foreign exchange markets, our net debt dropped by $6 million, despite 2 acquisitions for which we spent roughly $10 million net of cash. If we then move on to page 10, we're basically demonstrating here our organic growth on a quarter-by-quarter basis, as if all the constituents of the group that make up CentralNic today would have already been part of the group. And here you can actually tell or see the 16% growth from the first quarter 2020 to the first quarter 2021. With as every business that is in any way marketing related, the fourth quarter is normally the best quarter of the year. So this augurs well for the rest of the year, and obviously it's our objective to beat the Q4 2020 revenues by a good margin at the end of this year. You may ask yourself, how does this break out by segment? Which is the question that we answer on the next slide, number 11, where we basically break our total revenue out by the 3 segments in which we report. And for those who follow our group since a longer time, it is exciting news that actually the growth that we were already seeing in the online marketing segment has now spilled over strongly also into the indirect and direct business, which grew at 24% and 29% respectively. The latter segment, the direct segment, has been helped a little bit by the SafePrint acquisition that we announced earlier this year. The organic growth rate for both businesses, so adjusting for all M&A activity, was 13% in both businesses, the highest rates that the group has recorded so far. The online marketing business, so, is still growing at a staggering 75%. And when we net out the impact of the acquisitions of ZeroPark, Volume, and Bando, which we reported over the last 6 months, the organic growth here stands at 19%. Again, a record rate for this group. Moving on from the income statement to the balance sheet on to page 12. You will actually see the strongest balance sheet that the company has presented so far. Equity now stands at more than 1.5 times net debt, and we are presenting the most solid cash balance that the group has ever presented. And we are actually in that comfortable situation. If we then move on to page 13, because of very strong cash conversion. So in the first quarter 2021, we had $12.5 million of cash flow from operating activities, which is more than 10 times the the cash flow from operations in the first quarter 2020, and more than half that of the full year 2020. And also on an adjusted basis, if you go to the next page 14, where, as we've also done on more recent quarterly reporting roadshows, we also adjusted this for M&A and non-operational items. So the cash conversion has actually been 163% instead of 46% in the same quarter last year, which makes us very comfortable that we will match or beat the 115% adjusted cash conversion for the full year 2020 in this year 2021. This great cash flow has also put us into a position to complete quite a few acquisitions. So in the last year, just in November, we closed Codewise, which has substantially expanded our suite of services in the online marketing segment, which was before monetization, but now we have this full suite of demand side, supply side, and tracking services, which we offer as a software as a service solution. And then last but not least, we've augmented our corporate domain or enterprise business by the acquisition of Safe Brands, giving us a strong position in France. And through the acquisition of Wando, we further expanded our services in the online marketing segment by social marketing, display advertising, and SEM advertising technology. How did we do this? We will see on page 16. Right. So on the last two acquisitions, we've basically supplemented with a bond, with a tap of our bond, and I think here the most relevant point is that we have now much more credit with the debt capital markets than the company had when we first ventured into the debt market in summer 2019. So today, bond investors are actually paying us more money for our bonds than we actually need to pay back to them, which makes us very comfortable that when the bond comes up for refinancing, which can be any time at our choice between July next year and July 2023, that we will be able to refinance this bond at substantially lower interest rates than the rate that we are currently paying. And that should then also help us converting more of the EBITDA that we currently generate into net profit for our shareholders. Basically summing it up on page 17, significant investment in new management, staff, and systems is paying off through accelerated record level growth for our group. The good news here is, on top of the group growing as a whole, every segment is now delivering a double-digit growth, and we still have a lot of products in the pipeline that should drive our growth for the next quarters to come. And on all that, let's not forget this before the background of a pandemic, where many businesses, also including online business like travel portals, restaurant booking websites, and many others, have struggled quite substantially, but not us, where we were benefiting from the recurring nature of our business. Post the quarter end, we've still settled 1.4 million euros of deferred consideration on two historical deals. Team Internet, certainly a great success, one of the only acquired in December 2019. It has been driving much of our growth during the last 5 quarters. And Safe Brands, still a very young acquisition, on which we hope that we can report similar news as on Team Internet in the year to come. With that, I would hand back over to Ben Crawford to basically sum up and conclude and make some conclusion remarks.
Thank you, Michael. Oh, here we go. Thanks, Michael. I'm just trying to get my video to work here. Here we go. There. Thank you very much. So I guess in summary, we've talked about how the changes that we made last year to drive organic growth, and clearly those changes have been very successful and will continue to be. Our market consolidation strategy continues. There's some very attractive targets still out there, and as we've proven ourselves, very capable of sourcing great deals, closing great deals, and then growing the companies under our watch. We would obviously plan to continue with that path, and then finally, not surprisingly, we do expect to finish this year trading in line on the basis of not only our Q1 results, but everything we've observed about the reasons behind them. So thank you very much, everybody, for your attention today, and we'd be more than happy to take any questions.
Thanks very much, Ben and Michael, for a very interesting presentation. We have a few questions and a few minutes left to answer them. If anyone else would like to ask a question, do click the Q&A button at the bottom of your screen. Okay, so the first question comes from Stuart Austin, who asks, you're increasing your turnover every year, but have failed to make an annual profit. Why is this?
Do you want to take that one, Michael? I mean, obviously that's not really correct, but over to you. You're on mute, Michael.
Right. I just figured I can unmute myself. It's not the moderator anymore. Thank you. Yes. So the revenue has increased. The profit is, however, charged under IFRS 3 with amortization of the acquisitions that we do, which is not necessarily the standard that we appreciate or that we believe is in any way helpful for our investors to assess the success of the company. So basically, after we do a transaction, we need to allocate a certain part of that of the purchase price to immaterial assets like software rights, etc., and write them off through our income statement, which has, however, zero cash impact. So we are basically showing numbers that we never expense in our income statement, and that makes it our profit looks much lower than it actually is. This is why we're producing. This is why we're suggesting these alternative performance metrics, like our adjusted EBITDA figure, that we make the centerpiece of our reporting.
Thank you.
And it's probably just worth repeating that our adjusted EBITDA figure is a very good estimate of the amount of cash that we actually generate from our operations as well. So if you are looking at any kind of valuation metrics based on cash, that's proven year after year to be a highly predictable predictor of our cash flow.
Yeah, I mean, this does tend to be a characteristic of highly acquisitive businesses, but due to IFRS accounting, a lot of non-recurring costs have to be booked to the P&L, to the statutory P&L that relate to the acquisitions.
Sure, non-cash items, yes.
Yeah. On the subject of acquisitions, I mean, of course, cash has to be paid for those acquisitions. So Dennis Buckley is asking whether that cash will need to come from further equity issues, or whether you're comfortable to add to the debt to finance those further acquisitions.
Sure, I think we're very clear that that our existing investors, and we believe generally investors in AIM small cap stocks, have a comfort level, a specific comfort level for a net debt to EBITDA ratio. And our understanding is that's around 2.5 times. And so, which is around where we're sitting today or less than that. And obviously as a very highly cash generative company, then that net debt number reduces every day and the EBITDA number increases every day too. So we're definitely continuously moving in that direction of reductions. We've done acquisitions with cash on hand, with share swaps, debt financed and equity financed in the past. We believe in maintaining a sensible balance of those that keeps our share register happy. And so you could expect us to continue to do that in future.
Thank you, Ben. Then Edward Elul asks, why is the company listed on AIM rather than, say, NASDAQ, where a lot of tech companies obviously find their home?
Well, when we IPO'd, our revenues were $3 million, and I think we had 17 staff. We were on the small side for AIM. So look, so we've grown from that point. AIM's been great to us in that we have grown so far. We're 100 times the size we were then in terms of revenues, 7 years later. So, but look, you know, who knows? Eventually, there may be an arbitrage opportunity to list on another exchange to bring in investors who are, you know, a larger pool of investors who are focused on this. But our chairman is on the board of the Hut, and you know, he'll tell us, no, you can stay on AIM and do great. And so far they certainly have.
Thank you. Another participant is asking about the net debt to EBITDA target, which you just covered. I think there must be a misunderstanding there, as he seems to think it's 7.8 times. Maybe he's looking at the quarterly EBITDA. I don't know. As you say, it's more like 2.5 times.
Yes, exactly. That must be because I'm seeing the exact figure 7.8. This happens when you take our net debt of $79 million and divide it by the $10.1 million quarterly EBITDA. Not normally net debt to EBITDA would be expressed as net debt over the annual EBITDA, which is then of course much lower, somewhere around 2 times net debt to EBITDA, as Ben has just mentioned in his remarks on the other question on our total gross debt.
Yeah, that makes sense. Thank you. Okay, and I think the other questions have really been covered in the presentation. So thanks very much, Ben and Michael. A very interesting presentation, and we look forward to welcoming you again in the future.
Yeah, we'd love to come back. Thank you, Mark.
Thanks very much.